Most people think silver is waiting for a breakout. That is the mistake. The breakout is not the beginning. It is the moment the crowd finally notices what already started. If you want the signal before the noise turns into panic, are you already subscribed? Because this is not really a story about a shiny metal. It is a story about value, denial, and a market that has been whispering the truth for a long time, and most people still are not listening. The biggest silver mistake is not buying the top. It is thinking the old price is still normal. It is looking at a number on a screen and assuming that number still reflects reality. In markets, price can lie for a long time, right up until it cannot. That is what repricing means. It means the market slowly realizes the old price was too low for the real world. Not because someone said so, because supply, demand, fear, money, and trust start pulling in the same direction at once. And silver is dangerous in that kind of moment. Because silver is not just money, it is also an industrial metal. That means it lives in two worlds at the same time, and when both worlds want it together, the move does not stay calm for long. Most buyers still look at silver like it is stuck in the past. They remember old price levels. They remember long sideways years. They remember disappointment. So they keep waiting for the market to give them yesterday's deal in tomorrow's world. But the world around silver is not the world that existed 10 or 15 years ago. Debt is bigger. Trust is weaker. Geopolitics is rougher. And modern industry needs silver in more places than most people realize. If that changes the way you see this entire market, shouldn't you already be subscribed? Because the crowd usually looks for proof after the move is already painful. Smart people look for pressure before it becomes visible. And silver is full of pressure right now. To understand why this matters, forget silver for 1 second. Think about water in a city before a storm. On a normal day, the shelf looks full, the price looks stable, and nobody cares. Then the forecast changes, and suddenly the old price no longer matches the new reality. The shelf may still look full for a while, but the meaning of that shelf has changed. People are no longer asking, what did water cost last month? They are asking, can I still get enough when everyone else reaches for it too? That is how repricing begins. It starts quietly, not with fireworks, not with every headline screaming at once. It starts when the market stops treating something like a cheap extra and starts treating it like a limited necessity. That is what many silver buyers still miss. They think repricing starts when the chart becomes dramatic, but the chart is often late. The real shift starts underneath the surface, where inventories tighten, demand changes, and confidence in old assumptions begins to crack. Silver buyers who only watch spot price can miss the deeper move, because spot is just the most visible number. It is not the whole story. Sometimes the screen says one thing, while the real world says something very different. That gap matters more than most people think. If the price on paper says silver is ordinary, but physical buyers act like it is strategic, which signal matters more? The answer is simple. The market always respects the real thing before it respects the story around it. Now let's make this even simpler. Imagine a small-town hardware store selling generators before a blackout. The owner may keep the old price tag up for a day, but if the town knows the power problem is real, those generators are no longer just products, they become security. Silver is moving in that direction. Not because every person on Earth suddenly loves silver, because more parts of the world need it for more serious reasons. And when a market is not huge to begin with, even a modest shift in urgency can hit like a hammer. If you like hearing the deeper story before the headlines flatten it, why not subscribe now? Because silver is one of those subjects that looks boring right before it becomes explosive. And once that switch flips, people do not ask for perfect timing. They ask why nobody warned them sooner. One part of the silver story is old. Silver has been money for thousands of years. When trust in paper promises gets weaker, people naturally move toward hard assets. Gold gets most of the attention because it is the king of safety, but silver often moves later and faster. Why? Because silver is smaller. A smaller market can stay ignored longer, but when money finally rushes in, it does not take nearly as much capital to move the price. That is why silver can feel asleep for years, then act like it was storing energy the whole time. The second part of the story is newer. Modern industry uses silver because it is extremely useful. It conducts electricity very well. It shows up in electronics, energy systems, medical tools, advanced equipment, and parts of the digital world people depend on every day. You do not need to see silver to need silver. And here is where the tension gets real. A lot of silver is not mined from mines that exist mainly for silver. It often comes as a side product from mining other metals. So even if silver demand rises hard, supply does not magically respond overnight. You cannot force that kind of production to move like a light switch. That is a huge detail. People talk as if higher demand automatically creates enough new supply. But in the real world, mining takes time, money, permits, equipment, energy, workers, and stable politics. It is a slow machine, demand can jump fast, supply usually cannot. For years the market has already been feeling that strain. The world has been using a lot of silver, while fresh supply has not exactly flooded in. That does not mean there is zero silver left, it means the cushion is thinner than many buyers assume. And thin cushions matter when new demand shows up. This is the part most casual buyers miss. They think shortage means empty shelves everywhere. That is the movie version. Real markets tighten long before they fully break. They tighten through delays, higher premiums, lower flexibility, nervous pricing, and a growing fight over available ounces. If you still think this is only about a cheap metal trade, are you sure you're looking at the right story? Because when a market starts losing its extra slack, the next move is not just financial, it becomes psychological. And psychology is where repricing turns violent. Now add the energy story. The world keeps pushing for more electrification, more grids, more solar, more advanced systems. Even when industries try to reduce how much silver they use, the total need can still stay large because the scale keeps growing. That matters because silver is not just collected, it is consumed. Some of it comes back through recycling, yes, but not always quickly and not always cheaply. A metal that gets used in millions of products does not always return to market in a smooth, easy way. Some of it gets trapped in the background of modern life. So the silver market lives with a strange tension. On one side, it is a precious metal that people save. On the other side, it is a working metal that industry burns through. That combination can stay quiet when confidence is high. But when confidence drops and industrial need stays strong, silver gets pulled from both ends. And that brings us to the word most people hate hearing: deficit. Not because it means the market is instantly empty, because it means more silver is leaving than arriving in a given period. A market can survive that for a while by pulling from stockpiles, but it cannot do that forever without consequences. Think of it like a family spending more than it earns every month. Maybe they have savings, maybe the lights stay on, maybe outsiders do not notice anything at first, but the direction matters. And once the savings account starts looking smaller, the emotional mood changes fast. That is what repricing often looks like. The number stays lower than reality until reality becomes impossible to ignore. Then the market does not gently say, "Excuse me, I need to adjust." It lurches, it gaps, it scares people. It punishes hesitation. If you want analysis that respects what is coming instead of what already happened, are you subscribed yet? Because silver is the kind of market where late understanding can become expensive understanding. And the people who keep waiting for total clarity are often waiting for the price they wanted to buy. Now let's talk about another blind spot. Many silver buyers think only silver demand matters. It does not. Gold matters too. Because gold often moves first when the world starts worrying about debt, currency weakness, war risk, banking stress, or loss of trust in government promises. Gold is the alarm bell. Silver is often the delayed reaction with gasoline poured on it. When gold starts proving that the world wants hard assets again, silver does not need to invent its own reason from scratch. It can ride the monetary fear and the industrial need at the same time. That is a rare setup. And when that setup starts to build, old price anchors become dangerous. People say things like, "I'll buy when silver goes back to that level." But based on what? Based on history from a different cost structure, a different world, a different demand mix, and a different trust level. That is not analysis, that is nostalgia. Markets do not care what price made you comfortable in the past. They care what buyers and sellers must do now. If mining costs rise, if industrial use stays firm, if monetary fear grows, if available metal gets harder to source, then yesterday's normal can become today's fantasy. The market owes nobody a return ticket. This is why repricing feels invisible at first. The public expects one giant moment, but markets often move through stages. First, the insiders notice conditions changing. Then the committed buyers notice. Then the headlines notice. Then the late crowd arrives and calls it sudden. Silver may look slow right up until it looks fast. That is how compressed markets behave. They build pressure quietly. Then one day, what looked like a sleepy chart starts behaving like a trapdoor just opened under old assumptions. And everyone who laughed at urgency starts using urgent language. Another reason many buyers miss the shift is because they focus on the wrong kind of volatility. They see pullbacks and think the whole thesis is dead. But a repricing process is rarely clean. It is messy by nature. The market shakes people out, attacks confidence, creates doubt, and then keeps moving anyway. That is especially true in silver. Silver has a history of punishing weak conviction. It moves hard enough to scare traders, then hard enough to shock them for leaving. That does not mean every rally lasts forever. It means the road upward can be ugly even when the bigger direction is real. If you're the kind of person who wants the truth before it becomes comfortable, why are you not subscribed already? Because silver does not reward people who need everyone else to agree first. By the time agreement arrives, the market usually feels very different, and usually much more expensive. Now let's look at the paper side versus the physical side. This is where many buyers get confused. Paper markets can create a feeling of deep liquidity, They make it seem like silver is always there, always flowing, always easy. But a promise and a product are not the same thing. Most of the time, that difference does not matter much. People trade contracts, they settle numbers, they move on. But when stress rises, what people want changes. They stop asking, can I trade exposure? They start asking, can I actually get the metal? That question changes behavior, and behavior changes price. If more participants want certainty instead of paper convenience, the whole market tone shifts. It does not mean every contract fails. It means trust itself starts carrying a premium, and whenever trust becomes expensive, real assets become more powerful. This is one reason physical buyers sometimes feel like the screen is lying to them. They see spot price move one way, but actual coins and bars in the real world feel tighter or more expensive. That disconnect is not random. It is the market telling you that direct ownership and theoretical exposure are not identical during stress. And the deeper the distrust becomes, the bigger that lesson gets. People who thought silver was just a trade discover it is also a form of independence. No counterparty, no promise, no app needed, no system update required. Just an asset you can hold outside someone else's balance sheet. That matters more in a world that feels increasingly fragile. Bank problems can spread fast. Currency confidence can erode slowly until it suddenly erodes quickly. Governments can change rules. Capital can get trapped. Market plumbing can jam. When that kind of fear enters the room, silver stops looking like a hobby. It starts looking like an option on disorder, not total collapse, just disorder. The kind that makes ordinary people want a little more control over their savings and a little less dependence on perfect system behavior. And if enough people reach that conclusion together, silver does not need universal adoption to reprice. If this is making the whole system look different to you, wouldn't subscribing now make sense? Because the biggest shifts are usually hardest to believe while they are early. And silver is one of those stories where early disbelief is part of the fuel. That is why the move can grow while the crowd still shrugs. Now here is the uncomfortable truth for many silver buyers. Some of them are already bullish, but still mentally bearish. They say silver is undervalued, but they keep acting like lower prices are guaranteed. They want a repricing, but only after one more dip. They believe in scarcity, but only on a schedule that feels safe. That mindset is a problem. Because when markets truly revalue something, they often do it before the majority feels emotionally ready. The market does not wait for your confidence. It does not pause until every YouTube comment feels optimistic. It moves when pressure reaches the point where old prices no longer clear the market properly. And once that starts, the excuses change. First people say silver is dead, then they say the move is fake. Then they say they are waiting for a pullback. Then the pullback comes, but not low enough for their old mental anchor. Then they chase higher. This cycle repeats in every under-owned market. That is why psychology matters so much here. The biggest enemy is not always bad analysis. Sometimes it is good analysis with weak emotional discipline. A person can understand the silver case perfectly and still miss the move because they are anchored to a past that no longer exists. Knowledge alone does not save you from hesitation. The other thing people forget is that repricing is not just about investors. Industry can be much less price sensitive in the short term. If a manufacturer needs silver for a critical product, they do not always get to wait for the perfect dip. They may complain, they may substitute where possible, they may redesign over time. But near-term need can still force buying. That creates a nasty setup for retail buyers who think they have endless time, because industry is not collecting silver as a thesis. It is buying silver because certain products do not ship without it. That is a different kind of urgency. And when practical urgency meets rising monetary interest, the available float can feel much smaller than it looked on paper. If you want to stay ahead of moves driven by real-world pressure instead of internet hype, are you already subscribed? Because this is where silver stops being a meme and starts looking like a serious signal, and serious signals rarely wait for everyone to feel calm. So what does the repricing actually look like from here? It may not be a straight line. In fact, it almost never is. You can get sharp rallies, fast drops, confusing pauses, and sudden bursts that feel disconnected from the previous week. That does not cancel the repricing story. That is what the repricing story often feels like while it is happening. Think about a spring being compressed. The pressure builds slowly and invisibly. Then the release looks fast, even though the force was building for a long time. Silver has that kind of personality. Long patience on the front end, sudden violence on the back end. That is why people misread it so often. They think nothing is happening because everything is not happening at once. But markets rarely send a marching band before a big shift. They send little warnings, a stronger floor, tighter availability, more sensitivity to macro stress, more demand from places that used to seem small, more respect from people who used to ignore it. This is also why the phrase, "I'll wait until it comes back down," can be dangerous. Back down to what? To a level built for an easier supply picture? To a level built before stronger industrial demand? to a level built before harder geopolitical fracture and weaker confidence in paper systems? Cheap relative to what world? A lot of people think they are being patient. Sometimes they are just being anchored. Real patience is having a plan and sticking to it. False patience is waiting for the market to validate your old comfort zone. And in a true revaluation, comfort zones break before the public admits they broke. So what is the practical takeaway? First, understand the difference between trading silver and owning silver. A trade is about timing. Ownership is about exposure to a long-term shift. If you confuse those two, every short-term drop feels like a personal attack instead of a normal part of a volatile market. Second, do not build your entire view around one magical price target. That is how people freeze. Better questions are these. Has the world become more dependent on silver? Has trust in debt-heavy systems become stronger or weaker? Has new supply become easy and flexible, or still slow and limited? Those questions matter more than one number. Third, remember that silver is not a get-rich-quick button. That belief destroys discipline. Silver can be explosive, yes, but the real opportunity is deeper than a quick pop. It is the chance to own something the market may have spent years mispricing while the world quietly changed around it. Fourth, respect volatility. Silver can move like a storm. If you use money you cannot afford to leave alone, the market will likely shake you out. The goal is not emotional heroism. The goal is steady conviction. Strong hands are usually built by position size, patience, and clarity, not by adrenaline. And finally, stop waiting for perfect certainty. Perfect certainty is what people ask for when they want the reward without the discomfort. But repricing always feels uncertain while it is early. That is why it offers opportunity at all. If everyone felt safe, the repricing would already be mature. If this helped you see the difference between price noise and a real shift in value, are you subscribed yet? Because the next phase of this story may not announce itself politely, and the people who understand the setup before the crowd usually sleep a lot better when the crowd finally wakes up. The deepest truth here is simple. Silver is not only being revalued as a metal, it is being revalued as a message about strained supply, about rising industrial importance, about declining trust, about what the market chooses when the easy assumptions stop working. That is why this topic matters beyond investing. Silver sits at the crossroads of money, technology, energy, and confidence. When it starts repricing, it is not only telling you something about silver, it is telling you something about the system around it. And systems only whisper before they finally shout. Most silver buyers are still looking for a headline moment. They want one giant event they can point to, but the real world is messier than that. By the time the shift becomes simple enough for everyone to explain, it is usually too late to benefit from early understanding. That is the cost of waiting for total clarity. The market may still swing. It may still scare people. It may still try to convince you that nothing is happening. But under that noise, the logic keeps building. Silver is needed. Supply is not endlessly flexible, trust is not getting stronger, and old prices are not sacred, so no, the repricing is not something that might begin one day in the distant future. For anyone paying attention to the deeper signals, it has already begun, not loudly enough for everyone, not cleanly enough for the comfort crowd, but clearly enough for those willing to see beyond the screen, and when the wider public finally recognizes it, they will call it sudden. They always do. They will act like silver came out of nowhere. It won't. It will be the result of pressure that built in plain sight, while most people kept staring at outdated price memories. That is how markets humble crowds, not by hiding the truth forever, by showing the truth early in a language most people do not respect until it becomes expensive. And silver may be speaking that language right now more clearly than ever. When the old price dies, the crowd calls it a surprise, but the prepared call at the moment the signal became too loud to ignore. If you want to be with the people who hear that signal before the panic does, why not subscribe now?